We have gone back and forth on Palantir. The Twitter world, the YouTube world loves Palantir. We question a lot of things here. They went from reporting growth rates to all of a sudden not talking about growth rates. We think it's unrealistic. There's some weird stuff happening with stock options. All of a sudden, people need stock options to hit. There's conveniently beating by 1 penny with some new assets occurring on the books. Guys, Palantir is a company that's talked about a lot, and we've engaged about it. It's at $17.41. As recently as earlier this year, was at $5.84, hit an all-time high of $45 just 2.5 years ago. Guys, we're very big on this. If something seems too complicated or too hard to understand, it probably is. So let's take a look at this. One of the positives of Palantir is their free cash flow keeps growing. Last year's free cash flow was $375 million, and they reported a loss of $48 million. We like the fact their free cash flow is higher. But you want to make sure that the executive team is on the same page as you. And when I see things like they conveniently beat by a penny 2 quarters in a row, and they were at, when we dove into it a little bit further with Dalton, our research analyst, he said there's something weird. They didn't report this asset before. Now suddenly they did. Now they have a gain on that asset that puts them exactly 1 penny above estimates where they needed to be. That's a little shady,
yes.
Right?
Yep.
Now, guys, every investment is the present value of all your future cash flows. And when you're buying a stock, you're buying a piece of a business. Let me ask you this question. If you didn't trust your neighbor and he came to you and said, hey, invest in my company, what would you say?
No.
You would say no.
Move on.
Absolutely. And that's the question we have with Palantir. So with Palantir, guys, let's look at analyst estimates here. They're showing a profit here of analysts who are very enthusiastic people are showing 23 cents per share. And this amazingly growing company that's killing it, 4 years later, is only doubling.
Yeah,
that's a lot of growth here.
It is, but it shouldn't be for the amount of hype and cheer that's behind this.
Correct.
You know what I mean?
Now, Palantir was started by Peter Thiel, and I'm a big fan of his. However, I look at this just thinking to myself, Mo, let's look at the 8 pillars here. Look at their shares outstanding. Have increased 189%. Guys, for those of you, I want you to understand, this is almost tripling. Not almost doubling, 100% is doubling, 200% is tripling. This almost triples the shares outstanding. So you might be wondering, oh, big deal, what's the big deal? At least they're taking the money in and using it to grow the business. Sure. But let's say a company has 10 shares outstanding and you have 1. And all of a sudden they triple their shares from 10 to 30. You still own 1 share. But now you own 1 of 30 instead of 1 of 10. Your ownership went from 10% to 3.33%.
That's how that kills you.
Yes. Is that something you want your management team doing? Do you want them diluting you like crazy? Now, with that said, Mo, how has their dilution been lately?
Well, let's take a look.
Let's go quarter to quarter.
Okay.
Are they still diluting? Very little.
It's getting way better.
Way better.
I mean, before it was unbelievable.
Yeah. So they've definitely slowed down. Why? Well, their free cash flow is positive. Another big positive for the company, Mo, their market cap is $37 billion. That's if you bought every share outstanding. But look at their enterprise value, only $35 billion. That means they have basically negative debt. They have more cash on hand than debt. That's a great thing.
Yeah.
And you can't really, it's hard to manipulate the cash on hand of a company.
Right. And I think you mentioned that 10 quarters in a row of positive cash flow.
I didn't mention that,
10,
but I think
11.
it's 10, it's something like that.
Yeah.
10 or 11 quarters in a row of positive cash flow.
Yep.
Now, you might be wondering, well, why are they reporting negative income? Well, guys, they're a software business. It also probably has to do with the way they write things off and how that works. But the bottom line is, if it was the other way around, I'd be a lot more concerned. I still wonder about management.
Right.
I still wonder about management. Now, guys, we were saying when Palantir was at $40 to $45 a share, this is why I want you thinking about how we look at things. Mo, what did we say we were interested in Palantir at when it was $45 a share?
$5.
$5. Now, here's the deal, guys.
And that sounded insane.
It had gone from $9 in December of 2020 all the way to $45 just in January of 2021. And we were sitting there saying, guys, pump the brakes. That's what I want you guys to remember. We're here to sit there and say, hang on a second, is this rational? We're okay being wrong. Just like now, people see my stocks that I'm owning and they're like, Paul, they're going down. Yeah, I know. I hope they go down further. The difference is with a company like Palantir and these other YouTube hypesters who are promoting it, they need the stock to go up for them to be validated. For me, I'm playing a 5 and 10 year long game. If you're not here for the next 5 or 10 years, you shouldn't be following us. Don't follow us.
The price validated the story and vice versa for quite some time.
Yeah.
And then it didn't.
And that's the thing, the story.
Then the numbers started to actually matter and things started to matter. And that's when the price came down to nearly $5.
I'm stuck on Palantir because I look at Palantir and I look at it going, okay, it's fallen from 45 to 6.
Mm-hmm.
That piques my interest. Then I started doing our stock analyzer tool. Let's actually pull this up. When was the last time you did stock analyzer on Palantir, Mo?
Let me check.
So I'm going to pull it up. Because guys, the great thing about stock, I always hear this, Paul, growth investing is different than value investing. No, it's not. The very first part of our value investing stock analyzer tool is growth. The very first line. So whenever somebody says growth investing is different than value investing, I immediately stay clear of that person. They don't understand investing. Investing is merely saying, what can I pay today for a future cash flow?
Mm-hmm.
And if we assume a lot of growth, we pay more for it. If two companies are exactly the same, both make $1 billion, but company A has 20% growth potential for the next 10 years and company B has 3%, which one am I going to pay more for?
Company A.
The difference between a value investor and a growth investor is the growth investor pays whatever price they can for that company because it's growing. A value investor says, listen, 20% growth is awesome, but there's still a point where you can overpay for that. That's the difference. You can overpay for a good thing. Investors understand that. Speculators, under the mask of growth investors, they'll sit there and say, I'm a growth investor. No, you're not. You're a speculator. An investor understands that there's a future stream of cash flow and there's the appropriate price to pay for it. Be a real investor. Follow us for that process. And it takes some time. And the unfortunate part is that you're going to miss out on some really big hype that goes up very quickly. But you're also going to miss out on some hype that makes things fall. You know how I am as an investor? When a stock that I want falls, you know what I do? And I buy more. If I own it, I buy more. If it falls and I want to own it, I get really excited. Nothing gets me more excited than a stock I own falling more, because then I can buy more. And I have absolute proof that I've done that. These other guys bail. What are you laughing about?
There's a stock this weekend that we were talking about, and it has basically gone up 20% since we recently bought it. It's a supermarket, and we're both, or me, you, Dalton, we're all like, what the hell is going on here? What is this?
Listen, I'll tell people what it is. Oh, we can't tell people. It's too small.
I think it's that.
No, I don't think it is. It's Sprouts Farmers Market. Don't buy it, but that's the proof. We started buying it in the low 30s, and we were livid that it hit 45. It's up more than 20%.
We had a group chat, and we were talking about how upset we are that it's up this much.
Literally, we're upset. The market's down, and the stock is up a ton. That is a true investor.
Because we know that we don't know, but the company is going to do well over time and reward us over time. We don't need instant gratification of being up 20% within 3 months or whatever.
In fact, we want the opposite. We want everybody else to sit there and get upset about it. That way the price goes lower and we still believe in the long-term economics of the business. That's a true investor. That's the nugget we're providing for you on this channel. That there is a difference in the stocks in the short run are a voting machine. In the long run, they're a weighing machine. In the short run, what's popular will go up, what's not popular will go down. But in the long run, the fundamentals of the business will drive the stock price, as long as you pay an appropriate price today. Now, guys, you've seen me talk about this community, talk about the software, and I'd love for you to join. But I know that you can't possibly make an informed decision today. I'm not asking for that yes or no today. What I'm asking for is that informed decision. Just like with investing, I want you to be informed. So what am I doing here? Just like you're going to buy a car and take a 15-minute test drive, take a test drive of the software. Join the community here, engage in the community, see the thousands of people here who talk every single day, exchanging thousands of messages. Use all of our tools here for 7 full days, full free access. Go to everythingmoney.com. At that point in the next 7 days, if you choose not to join, no harm, no foul. Keep watching our videos. You'll learn a ton. And I'm sure at some point down the road, you'll see the value in our community and then our software. But at the end of 7 days, you find the value, welcome aboard. It's going to be awesome. But take that full test drive, full 7 days at everythingmoney.com. And I guarantee that you'll, in the 7 days, realize how awesome the software is based on the 1,500 or 2,000 people who've already taken us up on the free trial in the last 2 or 3 weeks. So Palantir. I did it. I did a 10-year analysis.
Okay.
I did 8, 16, and 24% revenue growth. What'd you do, Mo?
I did the same. I think we're going to have the same. I think we did this at the same time.
Now, profit margin. It's hard because, right, I did 10, 20, and 30.
I did the same.
Free cash flow, 15, 25, 35.
Yep. A little easier.
Okay, PE, I did 15, 20, and 25.
I did the same numbers there.
Same with price of free cash flow. But look at this, Mo. I did a desired return of 15, 20, and 25. But let's do this, Mo. Let's put 10 all across the board.
Just to see what it's worth today.
And guys, the reason being is, if you sit there and say that the market's going to do 9 or 10%, for me, intrinsic value is basically 9 or 10%. So I want to sit there and say, what do I value Palantir at each low, middle, and high assumption based on 10% return? That's what I want to look at. Now, granted, before I put a much higher return, because I sat there and said, listen, there's still a lot of questions about the company's growth potential, et cetera. But let's say these are correct. I hit the analyze. Now, remember, this doesn't mean go buy at these prices. It means this is what these assumptions make the price of the company based on today's value. Go ahead.
And here's the other thing. We have so many questions about this. For me, it's almost like even if this lit up green, I still don't think I would buy Palantir. That's just because I'm going to go find another company. You know what I mean?
It's more stable. I can get a better return. Okay.
Less unknowns.
So 10% returns, guys, a low price of 2, a high price of 27 to 30, a middle price of 8 to 10. Now you might be wondering, what the heck, Paul? That's such a wide range. Well, yeah, it's a fast growing business. The range of price potential is huge, and that's okay. Now, putting my margin of safety in, 15, 20, and 25%, $1.30 to $2, high side of 8.50 to 10, middle price of 4 to 6. So 4 to 5. So again, it goes back to my, okay, if it goes below 6, I'm going to start to take a look at it again.
Yep.
And only at 584 is its low in the last 2 years.
Yeah, very recent.
So guys, I want you to remember to learn the process of looking at a company and saying, I'm buying a stream of income. And that income over time is going to go like this. But over time, it should go like that. Be the buyer when income is low. That's the big key there. And the hard part is you got to do it when other people don't agree with you. Guys, thank you very much for your time. I appreciate it.